If I hadn't made a foolish mistake 50 years ago, I could be twice as wealthy today. I'm not exaggerating. It's simple math. Compound interest works both ways, multiplying your gains, but also multiplying your mistakes. Let me share an uncomfortable truth. By the time you reach 50, most of the big opportunities are already behind you. Your career path is largely set. Your family life is settled, and your ability to take bold risks has diminished. If you don't want to risk your retirement, you no longer need brilliance after 50. You need to avoid disasters. You need to be cautious about risks. People love to talk about striking gold in crypto, but that's just empty talk. When you reach 50, the real goal is survival. I grew up during the Great Depression. I watched people lose everything, not because they weren't smart, but because they borrowed too much, trusted the wrong people, or believed the good times would last forever. How sad. Faces change, but mistakes remain the same. Here's my advice for investing after 50. Focus on defense, not offense. Your offensive years were your 20s, 30s, and maybe even your 40s. Taking risks made sense back then because you still had time to recover. At 50, time is no longer your ally. Most people don't understand this. When they reach middle age, they keep chasing growth. They keep making mistakes. They jump into popular stocks or get rich quick schemes. What happens? Their retirement savings disappear faster than they can earn. Let me explain. I once knew a very smart man, an Ivy League graduate with a strong career. At 55, he felt he was falling behind his peers. So in the late 1990s, he made big investments in dot-com startups. By 2002, most of his investments were gone. He spent the rest of his life trying to rebuild what he had lost, a tragic waste of money and talent. The irony is that if he had invested in stable, reliable companies like Coca-Cola, Procter & Gamble, or Johnson & Johnson, he would have had no problems. Not flashy, not exciting, but stable. Sometimes stability is enough. For people over 50, the real threat isn't low returns, it's catastrophic loss. Losing your savings at 30 is one thing. You have decades to recover. Losing them at 60 is another. You might not be around then. That's the reality. Sorry, after 50, your goal isn't to be the smartest person in the room. The smartest person in the room is usually bankrupt. Your new goal is resilience. It's having enough. It's avoiding the mistakes you need to avoid. I always say, I just want to know where I'm going to die so I can avoid going there. The key to investing after 50 is knowing what will destroy you and staying away from it. Avoid debt. Debt is poison, especially if you don't have years to pay it off. Avoid speculation. You can't beat the market's great masters. Avoid complexity. The more complex an investment is, the more likely it is to be a trap. You can't afford to make mistakes anymore. Your best strategy after age 50 is to keep things boring. Boring portfolios, boring companies, boring investments. Boredom lets you sleep soundly at night. The financial world does not reward excitement. It punishes it. And that is a huge paradox. Survival is success. Protect what you've built. That is the strategy. If you're over 50, invest for stability, not drama, not excitement, just peace of mind. After the age of 50, the less exciting your investments are, the more exciting and peaceful your retirement life can become. Don't aim to get rich quickly. You will make mistakes. Don't think about dying penniless. Envy has destroyed more portfolios than market downturns ever have. People don't go bankrupt because they can't make money. They go bankrupt because they envy others who make more money. I believe envy is the most foolish of the seven deadly sins. And I say this sincerely. Why? Because envy brings no pleasure. Greed at least allows you to enjoy spending. Gluttony allows you to eat. Lust brings a kind of pleasure. But envy, with envy, you just watch. And envy while others enjoy life and wealth. Remember, envy is contagious. When your neighbor buys a luxury home, you suddenly think you need one too. When your sibling brags about a stock that's increased tenfold in value, your safe investment starts to look like a mistake. That's where the real problem begins. Let me give you an example. In the 1990s, Warren and I were doing boring jobs: insurance, candy, furniture stores, newspapers. None of it was glamorous. Meanwhile, kids half our age in Silicon Valley were making billions out of thin air. We looked like fools until the bubble burst in 2000. Those who mocked our slow investments suddenly went bankrupt. We were still rich. The lesson here: the goal in this game isn't to beat others, it's to not lose yourself. Envy makes you forget that. I once knew a man who was quite successful. He saved, invested regularly, and lived comfortably. But then his golf buddies made money on oil stocks. He couldn't stand them making more money and became jealous. He borrowed heavily, leveraged himself heavily, and joined them. When oil crashed, his portfolio crashed too. His friends lost money too, but they were still working. He wasn't. After 50, most of your working life is behind you. You can no longer make up for your mistakes. A single impulsive move can wipe out decades of patience. You have to be careful. The best investors I knew didn't care much about showing off. They didn't envy their neighbors' hot picks. They didn't chase after what CNBC was shouting about. They focused on paying off their debts, building stable value, and protecting what they had. Ironically, if you want a peaceful old age, you should sincerely wish others well. Don't let other success poison you. It will take away your happiness. Imagine being 60 or 70 years old and still angry because someone else has a bigger house. How pitiful is that? I have outlived many people who were wealthier than me. I never envied them. Most were playing games they couldn't win. In the end, most were exhausted, had lost everything, or were overcome by despair. The wisdom is simple. Don't let envy dictate your decisions. Protect your peace more than your pride. Meanwhile, I had to live a boring, stable, and consistent life. If you're over 50, here's some good advice. Stop carrying the burden of other people's lives on your shoulders. Stop living your life according to your neighbor's lifestyle. Stop caring about financial gossip as if it were important. Jealousy won't make you richer. It won't make you smarter or wealthier. It won't even motivate you. It adds no value to you. It will only push you to make foolish decisions. Remember, in your retirement, it doesn't matter how much richer others are than you, how much money they make or don't make. It doesn't matter to your family, your friends, or the market. It only matters to your ego. And your ego has bankrupted more investors than any market crash. Envy is not just a sin, it's also a terrible investment strategy. Don't fall into this trap. I talk more about my mistakes than my successes because they are more useful. Everyone likes to listen to the winners. Very few people stop to examine the losers. That's where the real lessons lie. Here's one of my mistakes. Decades ago, I invested in a company I didn't fully understand. It looked cheap on paper, the numbers looked clean, management seemed competent, but I didn't examine the business model carefully enough. As a result, I made a small profit, but exited too early. If I had been patient and disciplined and stayed in the position, that position alone could have doubled my net worth. I'm not exaggerating because this is a mathematical fact. Compound interest does not reward early exits. The mistake wasn't in the investment. The mistake was mine. I failed to show discipline and resolve in the face of a truly great opportunity. In the end, I chose what felt right rather than what was right. And that's where I made my real mistake. Most investors do the same thing. They sell winners too early and hold on to losers for too long. It should be the opposite. You should do the opposite, but it's hard. Human nature pulls you in the wrong direction. People want clarity. When something rises, they want to secure their profits to feel safe. But selling Coca-Cola after a modest rise in the 1970s wasn't safe. It was foolish. The stock continued to gain value through compound interest for decades. While everyone was celebrating their early profits, they were quietly losing the wealth they could have had. I don't blame them. Regret is useless now, but I use this memory to remind myself of a simple rule. When you find a truly great investment, clasp your hands together and hold on tight. Don't try to be smart. Ignore the urge to act. The world constantly pushes you to do something. Turn on the news. There are endless reasons to trade. Elections, wars, inflation, politics, but most of it is just noise. Great trades survive. Great trades grow. Your job is not to predict the headlines. Your job is not to sell the goose that lays the golden eggs. Your job is to know the value of what you have. This lesson is even more important for people over 50. You don't have the luxury of waiting 40 years or more to recover from your mistakes and benefit from compound interest. A single wrong exit, a single wrong timing, a single emotional move can cause you lasting damage. I see this all the time. Someone holds a reliable dividend stock for years. Then they read a dramatic headline and panic sell. They replace it with an exciting new IPO. Then, a few years later, they wonder why their income dried up and their accounts are bleeding. The mistake wasn't failing to predict the future. No one can do that. The mistake was abandoning what worked for something exciting. Excitement and envy are terrible investment strategies. If I had learned this earlier, I could have been richer, but at least I learned it. Most people never learn it. They spend their lives jumping from one opportunity to another, while their quiet neighbors, the boring investors, get rich and live their lives. In short, it's not intelligence that makes you rich. It's resilience. It's the ability to be patient while others chase distractions. If you're over 50, you don't have the luxury of repeating my mistake. When you find a business that will still be profitable 20 years from now, hold on to it tightly. Be patient. Wait. Don't ruin it by trying to be clever. Don't throw it away. After all, markets reward patience, not intelligence. I didn't get rich because I was the smartest. I got rich because I avoided acting foolishly. I understand this truth better as I get older. Most people are overly confident, and the market eventually punishes that arrogance. I've been watching this happen for almost a century. In the 1930s, people believed prosperity would never return. They hoarded cash and missed the recovery. In the 1960s, everyone believed American companies would grow forever. They paid any price, and in the 1970s, they crashed. In the 2000s, people believed technology would rise forever. We all know how that turned out. Confidence is a good thing, but it doesn't guarantee accuracy. In fact, I observed the opposite. The most confident people were often the ones who lost the most money. The truth is, the world is too complex for anyone to know everything. You can't get rich by claiming to know everything. You get rich by knowing what you don't know and staying away from it. When Warren and I founded Berkshire, we passed up thousands, maybe more opportunities. We ignored them because we didn't understand them. And guess what? We didn't miss out on much. The world constantly offers you opportunities. It provides possibilities. You don't have to pursue them all. However, most investors can't resist this. They think having an opinion on everything makes them smart. They want to predict where oil will go, what interest rates will be next year, how a new startup will disrupt an industry, but they can't. What they don't say is that 90% of those ideas will be wrong. After 50 or 60, this flaw becomes even more dangerous. You don't have the luxury of making mistakes like you did at 30. If you invest your money based on a half-baked prediction, the market won't forgive you. And unlike when you're 30, you won't have that many years to rebuild. I once observed a successful lawyer in Los Angeles. He was a smart man with a good income. He decided he was also an expert in currency trading. He read a few articles, developed a theory, and made a big bet on yen. He lost most of his retirement savings. The problem wasn't that he was unpredictable. The problem was his confidence. If he had just said, "I don't know," and invested in something boring and sensible, he wouldn't have had a problem. However, people prefer to be wrong loudly rather than silently uncertain. What do you think? Here's my advice. Develop the courage to say, "I don't know." It's a rare and valuable trait. If you accept what you don't understand, you won't make foolish bets. You'll focus on areas where you are truly competent. At Berkshire, we did that. We understood insurance. We understood Coca-Cola. We understood sugar companies. So we bought them. We didn't understand airlines or dot-com stocks. And so we stayed away. We didn't take risks. This discipline saved us from disaster countless times. Overconfidence, arrogance, and envy ruined too many investors. It's not the market that ruins you. It's believing you know more than you do. That is arrogance. If you're over 50, here's an advantage. Stop acting like a prophet. You don't need to have an opinion on every industry, every trend, every country. It's enough to know a few things well and not be bothered by not knowing the rest. I'll go even further. The more confident someone is about the future, the faster you should run away. This has happened to you from time to time. The world is full of people selling certainty. Analysts, commentators, salespeople, they all talk smart. When their certainties ruin your portfolio, none of them will pay your bills. You will pay the price. The next time you want to make a prediction about something unpredictable, stop and ask yourself, what if I don't know? That question could save your retirement. One of the biggest distinctions in life is between those who think like employees and those who think like owners. It has nothing to do with job titles or salary. It's about mindset. Most people, even the very smart ones, spend their lives playing the career game. Promotions, titles, recognition, they chase after all of it. They spend years trying to impress bosses they don't respect. They polish their resumes instead of building wealth. This is careerism, and it's a trap. You fall into this trap a lot, don't you? I've said many times that it's not greed that drives the world. It's envy. Careerism is envy in a suit. When the guy next to you gets a flashier role, you suddenly think you need that too. But that's not ownership. Ownership is different. When Warren and I founded Berkshire, we didn't care about looking important. We cared about owning things that made money while we slept. Sugar companies, Coca-Cola, insurance companies. We didn't need titles or prestige. We wanted the checks that came in whether we worked or not. Over the years, I've watched the rise of brilliant lawyers, bankers, managers, and many others. They earned high incomes, but they owned nothing. The moment they stopped working, the money stopped. That's not wealth. It's just a high-speed treadmill. If you're over 50, stop chasing excitement and certainty. Choose ownership. Choose patience. Let your money work while you sleep. Let me give you an example. When I was studying law, I worked with some of the smartest people you can imagine. They charged their clients by the hour, made good money, and thought highly of themselves. But when they stopped working, their income stopped too. They had nothing scalable or permanent. They made a lot of money, but they weren't wealthy. Warren and I, on the other hand, dedicated our time to building assets. We wanted businesses that weren't dependent on our daily presence. That way, even if we were playing golf or gone forever, our assets would keep growing. That's the difference. If you're over 50, this lesson is even more important. You don't have the time to keep working long hours to earn money. Eventually, your energy wanes, your health changes, the treadmill stops. So ask yourself, do you have something working for you when you're not working? Rental property, dividend-paying stocks, shares in a business that keeps generating income whether you're there or not. If your answer is no, then you're not really investing. You're just extending your career. Do you think that's right? Careerism also corrupts judgment. Employees think about pleasing their bosses. Business owners think about things that will make money over time. That's an important difference. Someone focused on their career will do anything to impress those above them. A business owner asks, will this pay off in the long run? Only one of these questions leads to wealth. Here's the harsh truth. If you're over 50 and still living off your salary, no matter how high it is, you've been playing the wrong game. The good news is you can still change. Stop caring about titles. Stop caring how your colleagues see you. Start caring about ownership. This doesn't mean you have to quit your job. It means directing your energy and capital toward assets that will outlive you. By boring, durable businesses, live below your means. Stop spending money to look successful and instead build ownership by accumulating shares one by one. This is smarter behavior. No one will applaud you when you buy Procter & Gamble, but 20 years later, when the applause has stopped, those shares will still be working for you. Careers fade away. Ownership accumulates. At 70, only one of these matters. If you lived through the Great Depression, you never forget it. I was born in 1924. By the time I was old enough to remember, the economy had collapsed, banks had failed, businesses had closed, families had lost everything. Today, people see a 10% drop in the stock market as a fluctuation. In 1932, the stock market had fallen nearly 90% from its peak. That wasn't a fluctuation, it was devastation. I watched grown men lose their livelihoods. I saw families move in together because they couldn't pay the rent. My own family learned what it meant to save and use money wisely. The situation was grim, and it shaped my cautious outlook forever. The biggest lesson was to never assume good times will last forever. People forget that today. They think prosperity is the default setting. It isn't. Civilizations rise and fall. Economies expand and contract. If you live long enough, you witness both. The Great Depression taught me to respect reality. Optimism is beautiful, but blind optimism is deadly. Don't deceive yourself. Recognize the facts. In the 1920s, people believed prosperity would last forever. They borrowed, speculated wildly, and ruined themselves. When the crisis hit, debt destroyed them. That's why I've always despised debt. Debt makes you vulnerable. If you're debt-free, you can weather bad times. If you're in debt, hard times will severely impact your life. Another lesson, resilience beats intelligence. I've seen small, cautious, thrifty families survive. On the other hand, flashy gamblers with clever strategies vanished overnight. They weren't even survivors. They were just resilient. And this is a lesson most investors never learn. What do you think? If you're over 50, don't chase flashy strategies. Choose durability. Build wealth that lasts longer than you do. Everyone wants to be smart. No one wants to be resilient. Yet resilience is what gets you through periods that only need to be endured. Once I carried these lessons into my investment career, I don't try to predict anything. No one can predict. What I do is assume the worst will happen and prepare for it. This means building in a margin of safety. This means avoiding disaster. It means owning businesses that sell things people buy in good times and bad. Sugar, soda, insurance. People laughed at the sugar business. How much money can you make selling chocolate? They laughed. Well, people eat chocolate during recessions. They eat more during recessions. Meanwhile, look at how flashy companies collapse during economic recessions. This is a lesson you can only learn by seeing it. But if you're over 50, you need to remember this before experience teaches you the hard way. You don't have time to learn it again by going through another major crisis. Once you're financially ruined, you may not live long enough to rebuild. Therefore, build your portfolio for resilience, not for fantasy. When people boast about how much leverage they use or how clever their strategies are, remember 1932. Remember the breadlines. Remember the men who thought they were smart, waiting in soup kitchens. The world has changed since then. Human nature has not. People are still greedy, still overly confident, still jealous, still arrogant, still borrowing too much, still assuming good times will last forever. And every few years, reality hits like a slap in the face. So my advice is simple. Learn your lessons while the cost is low. You don't need another Great Depression to understand the danger of foolishness. All you need is humility and memory. If I were to boil down my so-called success to 3 habits, they would be these. I avoided debt, I avoided drama, and I avoided stupidity. That's it. There are no magic formulas, no secret systems, just subtraction. Start with debt. I've said it before. Debt is poison. It destroys discipline. It increases foolishness. Believe me and trust me. And when bad times come, and they always do, debt is the first thing to kill you. In the 1930s, people borrowed money using their homes as collateral because it seemed safe. When the crisis hit, they lost everything, their homes, their savings, their futures. Warren and I built Berkshire without using debt. Yes, we could have used leverage to increase our returns, but 1 or 2 bad bets could have ruined us like everyone else. Surviving was more important than looking smart. If you're over 50, reduce your debt. At 30, you can recover. At 60, the game can ruin you. At 70, it's too late for many things, and you'll regret it. You won't live long enough for compound interest to save you. You don't want that, do you? Now, let's talk about drama. I have 0 tolerance for it. I stayed away from unnecessary fights, meaningless conflicts, and chaotic people. Drama wastes energy. That energy could be spent thinking clearly, building with patience, or enjoying life. Many smart people have been ruined not by bad investments, but by bad marriages, bad friendships, and bad habits. What a sad situation. You can be very successful in finance, but you can still go bankrupt because of your personal ego. I had nothing to do with that. And when I say stupid people, I don't just mean those with low intelligence. I mean careless, dishonest, unreliable people, or those who are jealous, arrogant, and addicted to shortcuts. They are like radioactive material. Their foolishness spreads. If you stay around them long enough, it will affect you negatively. Early in my career, I saw colleagues partner with shrewd operators promising big profits. The pattern was always the same: fast talk, vague deals, inevitable collapse. Smart colleagues were dragged down simply because of this relationship. I made a rule. It's better to have fewer, but quality friends and partners. My partnership with Warren lasted 50 years, not because we never disagreed, but because we shared the same principles: rationality, patience, honesty, no drama, no debt, no stupidity. That's what made us resilient. That's how it should be. Most people underestimate how important it is to avoid mistakes. Everyone looks for the right stock, the right deal, the right opportunity. They ignore the fact that saying no is more important than saying yes. One right decision can make you money. One wrong decision can ruin you forever. If you're over 50, this isn't theory. You don't have years to spend correcting mistakes. There is no margin for error. That's why the rules get stricter. No drama, no foolish behavior. It sounds harsh, but it brings peace of mind, and peace of mind is far more valuable than a few extra points of return. Wealth is not gained through intelligence. It is preserved through discipline. And discipline is mostly the ability to avoid tempting follies. Stay disciplined. People romanticize my partnership with Warren. They imagine us playing chess in an ivory tower with billions of dollars, always agreeing, always smart. That's nonsense. What worked wasn't magic. It was discipline, temperament, and harmony. Did we make mistakes? Of course, but fewer than most people. The first thing that worked was complete trust. There was no backstabbing, politic, hidden agendas. That's rare in business. I didn't wake up wondering if Warren was plotting against me, and he never wondered about me. That trust created tremendous productivity. Most organizations waste their energy fighting internally. We didn't. We also agreed on money. We both valued patience, logic, and independence. We didn't care about looking impressive or getting Wall Street's approval. If something didn't make sense, we avoided it, no matter how much others mocked us. Another thing that worked was our complementary strengths. Warren was very good at identifying businesses with lasting value. I was better at reminding him not to get caught up in cigar butts, cheap, declining companies that generate a small profit and then disappear. Together, we set higher goals. We bought quality businesses at reasonable prices and held on to them. That difference was worth billions of dollars. Did everything go smoothly? No, people assume Berkshire did everything right. We didn't. Some things only seem wise in hindsight. We avoided many technology companies, not because we foresaw the future, but because we admitted we didn't understand them well. This caution was an advantage. That was also a success. We tried to fix companies that seem fixable on paper, but changing a culture is hard. If a company's fundamental character is rotten, new wallpaper won't fix it. We learned this the hard way. Yes, we missed some things, but we survived. And survival is an asset. My advice to you, pay attention to this. If you're over 50, The goal is no longer to look clever. The goal is to stay durable. Choose patience, choose trust, and avoid foolishness. That's how wealth lasts. But let me tell you this, if something is beyond my understanding, I prefer to walk away rather than blow up. This caution may have cost us billions of dollars in lost opportunities, but it has protected us from disasters that would have cost us much more. Our greatest strength was knowing the limits of our knowledge. Most investors don't have that luxury. They want to be experts in everything. Their egos wouldn't allow it. We weren't like that. We stayed within our circle of competence. If something was outside of that, we simply said no. This simple skill explains much of Berkshire's success. If you're over 50, approach your partnerships the same way. Ask yourself, does this person make me more secure or more vulnerable? Do they bring stability or drama? Do they strengthen my decision-making ability or pressure my weaknesses? The wrong partner can destroy decades of work. The right partner can multiply it. Ultimately, what worked between Warren and me wasn't magic. It was compatibility. When things didn't go well, it was usually because we had forgotten our own principles. So don't mythologize us. We weren't gods. We were two people who thought alike about money, and that was enough. It brought us closer to success, step by step. Here's something most people don't want to hear. Getting rich after 50 has much less to do with brilliant moves and much more to do with avoiding moves that will end in disaster. It's now a survival strategy, and you can still build wealth after 50. I've seen many people do it, but they didn't do it by chasing popular tips like 20-year-olds. They did it steadily, boringly, and with determination. The truth is simple. You don't need to double your money overnight. You just need to avoid ruining yourself. Discipline matters. Let me give you an example. I knew a doctor who earned well and lived modestly. At 55, he invested his savings in high-quality, dividend-paying stocks. He ignored the noise, reinvested the dividends, and lived below his means. By 70, he wasn't flashy, but he was financially free. He had no debt, a high income, and inner peace. Now compare him to another man I knew, a very smart entrepreneur who felt left behind. At 52, he invested all his savings in speculative real estate deals. When the market turned, he went bankrupt at 57. The difference wasn't intelligence. It was discipline. Here's the paradox. At 50, you don't need intelligence to win. You just need to stop doing stupid things. And believe me, the world offers an endless buffet of stupidity. Crypto scams, day trading madness, exotic real estate schemes. The list is endless. If you want to become rich or stay rich after 50, the rules are keep it simple. Only own businesses or assets you truly understand. If you can't explain it to your spouse in a minute, you shouldn't own it. Protect your capital. Every dollar you lose at 60 is more expensive than the same dollar lost at 30, because time is no longer your ally. Avoid envy. Don't let your ego get the better of you. Don't envy someone else's lucky streak. Your job isn't to keep up. Your job is to survive. Play defense. A steady 7% compound return over 15 years is a miracle by age 50. Double it, then double it again. When you retire, you'll look wealthy compared to everyone else chasing trends and burning out. Most people over 50 forget this. You don't have to be amazing. You just have to preserve your purchasing power. The world knows how to reward those who wait. The truth is, I never planned to be a billionaire. I just avoided stupidity long enough for compound interest to do its heavy lifting. That's the game. That's the mind. That's the discipline. So if you're over 50 and think it's too late, don't panic. You don't need to reinvent yourself. You don't need the next big thing. You need patience, simplicity, and resilience. It's not flashy advice, but it's the only advice that works. Don't ruin your life. Keep your motivation. If I were to tell you one hard truth, it would be this. If you spend more than you earn, no one can save you. Not me, not Warren, not even the smartest living advisor. Arithmetic doesn't care about your feelings. Your lifestyle doesn't care about your excuses. If you spend more money than you bring in, bankruptcy is inevitable. I've seen people with six-figure incomes fall into misery as they age because they couldn't resist their spending. And I've seen people with modest incomes enjoy a comfortable retirement because they live simply and invested steadily. This isn't about IQ. It's about behavior. It's about discipline. And excessive spending is the fastest way to ruin any financial plan. Whether you're 25 or 65, if you dig the hole deeper, compound interest works against you, not for you. People constantly ask me, Charlie Munger, what's the best investment at my age? My answer is usually this. Stop buying things you don't need. That alone solves most financial problems. At 50, every choice gets harder. You don't have unlimited chances to try again. Your decisions will lead you either to a dignified retirement or to dependency. The goal is not to show off. The goal is independence. It's not having to beg your children for money. It's about living your last decades with dignity. This isn't achieved by chasing the highest returns. It's achieved through restraint. And it protects you from disaster. If you reduce your debt, stay away from drama, stay away from foolish people, and live below your means, you've already won 90% of the financial battle. If you remain patient long enough, compound interest takes care of the rest. But if you overspend, forget it. No one can save you. Here's the final question. When you reach 70 or 80, will you envy your neighbor's toys, or will you enjoy your own freedom? The choice is yours. Implementation is rare. Remember, the world doesn't reward intelligence. It rewards avoiding stupidity. And there's nothing more stupid than spending so much that you drag yourself into misery. That's all there is to it.